At the beginning of 2001, Enron wasn't just another corporation. It was the model for what a modern American company should be. With nearly 30,000 employees and over $100 billion flowing through its books each year, Enron looked unstoppable. But by the time the year ended, the same company collapsed into what was the largest bankruptcy the world has ever seen. And in the wreckage, one of the big five accounting firms, Arthur Andersen, would be dragged down with it. So, how does a company that's valued at $70 billion and it's celebrated for innovation year after year fall apart almost instantly? Enron's origins date back to 1985, when two energy companies, Internorth and Houston Natural Gas, merged into a single entity. Kenneth became the CEO, and the company's now iconic E logo was designed by Paul Rand, the same artist behind IBM and ABC. Through the late 80s and 90s, deregulation swept across the American energy market. Prices fluctuated wildly, new opportunities opened, and companies who were bold enough to move fast started seeing massive profits. And Enron wanted to be at the center of that future. To seize the moment, Enron launched its own energy trading division in 1991. Jeffrey Skilling, a sharp and aggressive McKinsey consultant, took charge of the new trading arm, Enron Capital and Trade. Skilling enforced a radical concept of market-to-market accounting. This essentially permitted Enron to record future profits immediately, even if the funds may not appear for years, or perhaps never at all. This allowed Enron to essentially invent earnings based on projections it generated on its own. As you could guess, with this system, Enron's reported revenue shot upward throughout the 90s. Its stock price soared to over $90 a share, and employees were treated like rock stars. Executives promised that even bigger profits were coming. But behind the scenes, Enron's investments were quietly losing millions. And instead of faithfully reporting their losses, the company buried them. To cover any reported losses, Enron would utilize SPVs, or special purpose vehicles, which were smaller shell companies. Enron used these entities to hide its debts and keep falling assets off its official balance sheet. These SPVs were also funded with Enron stock, meaning leaders had no real protection if the company ran into trouble. As long as Enron stock stayed up high, the illusion held together. But everything changed with the dot-com bubble burst in 2000. Enron's expansion into broadband and technology backfired and investors became skeptical. Analysts began questioning how Enron made its money at all, and by early 2001, the scrutiny grew very intense. In February 2001, Kenneth stepped aside and Skilling became the new CEO. Within 6 months, the stock price had been cut in half. 6 months later, Skilling abruptly resigned, claiming personal reasons, and returned to the top role, assuring the public everything was fine while quietly selling millions of dollars of his own shares. In October, Enron reported its first quarterly loss in 4 years, driven by over $1 billion in charges from underperforming assets. The SEC opened an investigation, and 1 month later, Enron admitted it had overstated profits by nearly $600 million, going all the way back to 1997. At the same time, more than 20,000 employees were locked out of adjusting their 401k accounts for 30 days, while the stock continued to fall. A desperate attempt at survival came in the form of a proposed merger with Dynegy, a close competitor. But once Dynegy examined Enron's books, it backed out, citing undisclosed debt and a disturbing lack of transparency. By November 30th, Enron's stock had crashed to 26 cents per share, down from $80 back in February. And on December 2nd, 2001, less than a year after standing among America's corporate giants, Enron filed for bankruptcy, and the aftermath was brutal. Thousands of employees lost their jobs and life savings, and executives Kenneth and Jeffrey Skilling were charged with dozens of counts of fraud and conspiracy. Lay died before sentencing, but Skilling received 24 years, which was later reduced to 12. He was then released in 2019. But the fallout did not stop there. Enron's longtime auditor, Arthur Andersen, was convicted of destroying documents related to the investigation, and the conviction effectively killed the firm. This reduced the Big Five accounting firms to the Big Four accounting firms that now exist today. The collapse of Enron triggered sweeping reform. In 2002, Congress passed the Sarbanes-Oxley Act, imposing strict oversight of public company audits, limiting consulting work by auditors, and requiring top executives to personally certify their financial reports. Blaming ignorance was no longer a valid excuse. Enron's fall wasn't just the end of a company, it was the end of an era. It exposed how blind greed, unchecked ambition, and creative accounting could destroy even the most admired corporations. It also showed the danger of rewarding stock price over substance, and innovation without integrity. Today, Enron remains a warning that behind every revolutionary company, there must be accountability, transparency, and truth. Because when numbers lie, people pay the price. Remember, transparency builds trust, and trust builds value. Make sure to hit that like button, subscribe to the channel, and turn on that notification bell. We post weekly reels and new videos on Fridays. Thank you all for watching. Remember to always save smart and invest smarter.